Assalamu alaikum. Welcome to video 17 of financial reporting. This is IAS 32 financial instrument presentation. Now, financial instruments are divided into three separate standards. One is IAS 32, one is IFRS 7, and one is IFRS 9. So in this, we are going to only go through the presentation part. The main measurement, recognition, discontinuation, will be covered in under IFRS 9, and IFRS 7 is only on financial statements disclosure. So these three standards, they work together. Now, in this standard, the main question is whether to present the financial instruments as your financial liability or equity. Okay. IAS 32 says that a financial instrument has to be classified as a liability if if the issuer has a contractual obligation to deliver cash, that means to pay cash or another financial asset to the holder, or to exchange another financial asset or liability with the holder under conditions that are unfavorable. Financial instrument is classified as equity if no such contractual obligation arises. So in your exam, you should always see whether there is an obligation for you to pay the cash or not. If no obligation, it's equity. If obligation is there, it's debt. That means financial liability. Now, for example, preference shares could be classified both as equity and liability. If it's irredeemable, it's equity, and if it's redeemable, it will be classified as a debt. Now, one very common example they will often ask is compound instruments to test your knowledge of IAS 32. This is the only area they test on IAS 32, that is compound instruments, where an instrument has the element of both liability and equity in one instrument. One example is a convertible bond, a bond which you can convert to shares or cash. So bond is a liability, but because you can convert it into cash or shares, it has an equity component also, and we don't know whether we are going to convert it into cash or fixed number of shares, right? So you have to split the compound instruments into two parts, liability part and equity part. And often you have to first start your calculation by finding the liability part first. Equity is the balance. How? Present value of the repayment. That is the liability component. So the difference between the proceed, they will often give you what is the proceed, minus the liability component that you have found, the balance is equity element. And let's go through an example. So on 1st Jan, company issued 10 million 3% bonds. Interest is paid in arrears. So the loan notes will be redeemed in cash on 31st December 2006. That means after 3 years in the form of fixed number of ordinary share. First, you have to find out an interest. Let's say you are just having a loan and you want to convert it. You have to find the present value, but without the conversion part. So the interest on a similar bond without the conversion is 6%. So this bond you can see has the characteristics of both debt and equity. So you will split it into debt equity. First, let's find out the present value of the cash repayment discounted using the interest rate given for similar bond without the conversion, which is 6% in this case. So this is how it will go. Okay, forget about the present value. Let's see how we got the present value 9.2. So your cash amount is 10 million. Often they will give in the question interest rate, amount, interest rate, everything will be given. You just have to find out, do the calculation. So 10 million into 3% into 1 divided by 1.06, because for the first year, end of 31st December 2004, only for 1 year. Why 1 divided by 1.06? Because 6% is the interest. You are discounting now. So if you discount it at 3%, 10 million of 3%, it is 0.28. Then for 31st December 2005, same calculation, the whole thing is 1 divided by 1.06 to the power 2, because this is for 2 years. And then for the third year, 10 into 3% into 1 divided by 1.06 to the power 3. But remember, this time you have to add another 10. Why is that? Because the principal amount you will pay at the end of 31st December 2005. By the third year, you are going to pay the interest plus the principal amount, which is 10 million. But in the first 2 years, that is 2004 and 5, you are only paying the interest. That's why we are taking only 3% of 10 million. And that's why you see your amount is more. It's 8.65 in the third year. So you will add all, that is your present value. When you add 0.28 plus 0.27 plus 8.65 is 9.2 million, which is the present value of cash repayment. So Double entry will be, you should know the double entry. You debit cash because you're receiving cash and you credit the liability 9.2. Now, you see the difference? There's a difference. That difference is credited in the equity 10 minus 9.2, which is 0.8. Now, so at 31st December 2004, remember we have to find the interest on 9.2 million. So that is the present value of future payment, which is 9.2. So you have to find 6% of that 9.2, which is 0.55. So this 0.55 will be charged to your statement of profit and loss. It's an interest expense. Okay, and you have to deduct it from the liability. Sorry, you have to add it with the liability, because with your capital amount this interest also will be charged, which is 9.2 plus 0.55 minus 10 into 3%. Why 10 into 3%? The interest of the next year you have to deduct. Okay, so your liability will be 9.45. Now equity is not remeasured, only the liability is remeasured. Okay, so that's it for IAS 32. Make sure that you do questions on IAS 32. There are enough questions on compound instruments in your exam paper. You just have to go and do it right now, so that you are able to split the equity and the liability component and very frequently asked questions. So make sure that you do this question right now. And I shall see you in the next standard. The next standard is IAS 33, earnings per share. Another very technical standard with lots of calculations.